When gold blasts through $4,000 an ounce, that's not a victory lap for investors. It's a siren. It's the signal that the financial world you've been told is stable is quietly breaking underneath your feet. Gold at those levels doesn't mean everything is fine. It means the system is out of control. The metal that was marketed as a calm little hedge has turned into a flashing red warning light. This isn't a normal cycle. It's not business as usual. Every time gold has made a move like this, the story hasn't ended with volatility. It's ended with collapse. Most people hear gold at $4,000 and think, wow, that's a great return for gold investors. They treat it like just another asset breaking a new record. But gold doesn't hit those levels in a healthy world. It does it when trust in everything else is evaporating. Gold is like a mirror. It doesn't change reality. It reflects it. When the reflection becomes this extreme, you're not looking at enthusiasm, you're looking at fear. At gold, $4,000 and beyond, the market isn't saying gold is amazing. It's saying currencies are sick, debt is toxic, the system is unstable. The move from roughly $2,000 to over $4,000 in less than 2 years isn't a gentle trend. It's a sprint. That speed matters. Slow climbs usually come from optimism and growth. Violent spikes come from panic, repositioning, and desperate attempts to escape a burning building. So when gold hits levels that once seemed impossible, don't just ask, should I buy some? Ask a deeper question. What is so broken that trillions of dollars are fleeing into one of the oldest, simplest, heaviest forms of money on Earth? Because gold doesn't move like this unless the rest of the story is about to get dark. We've all heard the simple story. Stocks down, gold up. Stocks up, gold down. A neat little seesaw. That's how gold is sold, like a comforting insurance policy you tuck in the corner of your portfolio and forget about. But that's not how it behaves during real crises. Gold doesn't surge because it's nice to have. It surges when serious money stops believing in everything else. When governments stretch their budgets beyond logic. When central banks tamper with interest rates until the system bends. When investors realize the digits in their accounts are only as strong as the promises behind them. The real dynamic isn't gold versus stocks. It's gold versus confidence. When confidence in debt, banking, and currencies erodes, capital looks for somewhere it can't be inflated away or defaulted on with a speech. That's when gold stops acting like a side dish and becomes the main course. And here's the twist the textbooks rarely mention. Gold doesn't wait politely for the crash to be announced on the news. It often starts moving before the crowd even realizes what's coming. By the time everyday people see the headlines, gold is no longer whispering, it's shouting. Most of the time, gold is boring. It drifts sideways for years, nudging up and down while people focus on tech stocks, real estate, and whatever the hot trend of the decade is. During those quiet years, gold feels irrelevant. That's when people mock gold investors as outdated or paranoid. Then something breaks. Not in the gold market, but in the everything else market. Currencies begin to wobble. Government borrowing spirals. Central banks create money on screens faster than real economies can grow. Confidence starts to leak out of the system, slowly at first, then all at once. That's when gold stops drifting and starts erupting. It's not reacting to its own fundamentals. Mining didn't suddenly change. Jewelry demand didn't suddenly triple. What changed is the trust layer of the financial world. Once trust cracks, gold rushes to reprice the danger. And by the time you see a full-blown doubling, like a move from the $2,000 range to well above $4,000, the situation isn't getting risky. It's already dangerous. Gold isn't predicting trouble. It's recording it. If you wait until gold looks insane to start paying attention, you're not early. You're already in the middle of the event. Look back at major crises and you'll see the same pattern playing on repeat. During the tech mania around 2000, everyone was obsessed with websites, eyeballs, and new economy dreams. Behind the scenes, gold had already stopped falling and began quietly turning up. While portfolios stuffed with vaporware were about to get shredded, real capital was slipping into metal. Fast forward to the mid-2000s. Banks were packaging garbage mortgages and labeling them safe. House prices were never going down again. Yet gold was steadily climbing, sniffing out the rot buried inside the financial system. It's important to understand, the doubling in gold hasn't been the cause of past collapses. It has been the symptom, a symptom that big players see the game as rigged, over-leveraged, or fake, and they're repositioning before the crowd catches on. Then comes the crash. Stocks crater. Credit seizes. Banks wobble. Only afterward does the average person look at gold and say, wow, it went up. They rarely connect that the move in gold was already underway, long before the pain became visible. History doesn't need your belief to repeat. It just needs people to keep ignoring the message embedded in the gold chart. Here's the trap almost everyone falls into. They assume gold will rise during the first shock of a crisis. It feels logical. Fear goes up, gold goes up. But in real meltdowns, the first move is often the opposite. In a full-blown liquidity crunch, people don't sell what's bad, they sell what they can. That includes gold. When margin calls hit, businesses face cash shortages and credit freezes. Investors liquidate anything with a bid. Even historically safe assets get dumped like furniture in a house fire. That's why, in some of the biggest panics, gold has plunged right alongside stocks, at first. But that's only the opening act. Once the forced selling is done, and policymakers react the only way they know how, by cutting rates, printing money, and throwing stimulus at every fire they can see, something flips. People suddenly realize the currency they're clinging to is being diluted. Savings are being silently taxed by inflation. Paper promises feel weaker. That's when gold detaches from the panic and starts its real climb. So if you only judge gold by how it behaves in the first wave of chaos, you'll misunderstand its role completely. Its real power shows up in the years after the initial shock. There was a time when crises were mostly regional. A stock market collapse here, a banking failure there, each one painful but contained. That era is over. Today, major economies are chained together through trade, finance, and currency systems. When one big player gets sick, the entire global body catches a fever. In the 1930s, the Great Depression ravaged the United States and parts of Europe, but many regions were still semi-insulated. In 2008, that insulation disappeared. A housing crisis in America nearly brought down banks worldwide. Policymakers fought back with low rates and massive money creation. Now we've reached the point where those tools are almost maxed out. Interest rates in many countries have flirted with zero or below. Debt has climbed to levels that make prior crises look modest. And yet governments keep borrowing, keep spending, and keep expecting the system to absorb more. Gold's explosion at this moment isn't random. It's global. Central banks from east to west are racing to convert their paper claims into physical metal. We're not dealing with a single sector problem or a single country's mistake anymore. We're staring at a worldwide confidence issue, one that gold is measuring in real time. There's one detail in this story that should genuinely scare you. The biggest buyers of gold now are the very institutions that create money. Central banks can conjure currency with a few keystrokes. They can issue bonds, manipulate rates, and coordinate policies. Yet increasingly, they are choosing to swap some of that power for bars of metal that just sit in vaults. Why? Because deep down they know their own product, fiat currency, has limits. They know that you can't expand debt and money supply forever without consequences. So they quietly do what individuals are told is old-fashioned. They accumulate real, finite reserves. When countries like China, Russia, and others load up on gold, they aren't making a fashion statement. They're preparing for a world where trust in existing currencies breaks down. Holding gold means they'll still have leverage when new rules, new systems, or new currency arrangements emerge. Think about the message that sends. If the people who literally run the money system are hedging against that system, What should the rest of us be doing? Gold at $4,000 is not just about investors. It's about the referees buying body armor. Debt problems don't exist in a vacuum. They mix with real-world events, especially conflict, and become something far more dangerous. War is expensive. It doesn't matter if it's fought with tanks, code, drones, or sanctions. It eats money. Governments already drowning in obligations must now fund defense, intelligence, logistics, and rebuilding. When tax revenues can't keep up, they do what they've always done in history. They issue more debt and turn on the monetary fire hose. That flood of freshly created money might stabilize things temporarily, but it steadily destroys the value of the currency itself. Prices rise, savings weaken. People feel poorer, even if their nominal balances look bigger. Meanwhile, nations on the front lines of geopolitical tension quietly stack gold. They're not just hedging inflation. They're preparing for economic warfare, sanctions, currency freezes, asset seizures, and trade disruptions. In that environment, gold isn't just an investment. It's a weapon, a shield, a bargaining chip in a world where financial ties can be severed in an instant. So when you see both record debt and rising conflict at the same time, and gold launching vertically in response, you're not looking at coincidence. You're looking at a system stepping on its own accelerator toward instability. Old textbooks say gold and stocks move in opposite directions. That neat relationship used to give investors comfort. If my stocks fall, my gold will save me. But something shifted in the modern era. As markets became more interconnected and leverage increased everywhere, crashes started pulling everything down at once, at least in the short term. We've seen times when equities, bonds, and even gold all fell together. That's not because gold stopped working. It's because the system became so stretched that under pressure, everyone scrambled for cash at the same time. In those moments, the market doesn't care what an asset should do. It cares who needs money now. What makes today especially alarming is that gold has already rocketed higher while stock markets are still sitting near elevated levels. Historically, the big gold moves came during or after major stock collapses. This time, gold is moving before the visible crash. That suggests one thing. The people with the deepest insight and fastest access to information aren't waiting for confirmation. They're acting on what they believe is inevitable. When gold and risk assets eventually fall together, don't mistake that for gold failing. It's simply the clean-out phase before gold claims its role in the next monetary chapter. It's tempting to view gold's rise as a prize for those clever enough to buy earlier, but in reality, the current surge is less like a trophy and more like a timer. Every new high is another second ticking down on a system overloaded with unpaid promises, unpayable debts, overstretched governments, central banks boxed into corners, citizens who believe their savings are solid, not realizing those savings are backed by increasingly fragile paper. When gold moves from one plateau to another, $1,000 to $2,000, then $2,000 to $4,000, it's not just repricing itself, it's repricing everything else. It's telling you that the old assumptions about safety, retirement, currency strength, and government control are outdated. The doubling is not the endgame, it's the prelude. After every major gold surge in history, societies faced hard resets, painful inflation, currency reforms, new rules, and new winners and losers. The uncomfortable constant? People who relied solely on paper promises lost the most. Those who held real, scarce assets kept their purchasing power and often emerged significantly stronger. Gold's move past $4,000 is not the moment to cheer. It's the moment to ask, what is this countdown leading to? And which side of the reset will I be on? If you've watched gold's rise like it's just another line on a chart, you've missed the message. This isn't about bragging rights for gold investors. It's about the health of the entire financial structure that your job, your savings, your retirement, and your daily life sit on. When central banks hoard the one asset they can't print, when debt hits levels that can't be repaid honestly, when wars demand money that doesn't exist, when gold doubles in record time while stocks pretend everything is fine. That's not noise. That's a siren. You don't need to become a doomsday prepper. You don't need to sell everything and move to the woods. But you do need to stop assuming the system will always bail you out. You need a plan for a world where money works differently, where inflation is not a temporary glitch, and where confidence in paper fades much faster than anyone expects. If this opened your eyes, even a little, don't just click away and forget it. Hit subscribe. Stay plugged in. I'll be breaking down what this means for your savings, your income, your investments, and your future in plain language before the reset becomes headline news. Gold has already sent the warning. Now the next move is yours.